Okay, so I just wanted to do a quick update on this is like the interest rates and the Federal Reserve and their statement that they released. This is going to kind of be in effect for looks like a long time to come, but I'm just going to read to you the statement release and then give you my input. So it says recent indicators suggest that the economic activity has been expanding at a solid pace. Job gains have slowed in recent months but remain strong, and the unemployment rate has remained low. Inflation remains elevated. And the good thing is, I just seen the jobs report today. I believe it fell to 201,000, which is the lowest number since January. So this is some of the data that they're using. Obviously, they can see this before it gets released to the public. So this is some of the data that they're using to kind of gauge whether or not they should cut rates and what speed and stuff like that. So when they see these indicators and stuff like that, it all kind of weighs into their decision making. But anyway, back to the report here. It says the U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. The committee will continue to assess additional information and its implications of monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with the monetary policy affects economic activity and inflation, and economic and financial development. In addition, the committee will continue reducing the holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in the previously announced plans. The committee is strongly committed to returning inflation to its 2% objective. Let's see, blah, blah, blah. We're going to continue to monitor the implications. The committee will be prepared to adjust the stance of monetary policy as appropriate if risk emerge that could impede the attainment of the committee's goals. Blah, blah, blah. Inflation pressures and inflation expectations and financial and okay. So long story short, they are going to maintain the range of around 5 to 5.25%. They're not dropping anything. And over the long run, so this is even if you look at the complete report, they're expecting a decrease of about 0.08% for the next pretty much 28 months. So when they put this type of language in there and they say, oh, over the longer run, okay, this is, longer than we've been saying, because every quarter or so we say, oh, longer, 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 slow and steady, slow and steady. So it's looking like they have about a 28-month plan to get us to around that 2% mark. And if we're still 5.5%, 5.25% right now, that's going to be a little over 2 years until we hit that 2% mark. So what does that mean? That means that we're going to have higher rates as far as to buy cars, higher credit card rates. These mortgage rates are going to come down very slowly. And this is, and when they put that little clause in there saying that, we're going to monitor risk and emerging risk and stuff like that. This is assuming that nothing dramatic happens over the next 2 years and a few months, right? This is in an ideal situation that's smooth sailing in order for us to hit like this target rate. So if you are, thinking about even student loan rates and stuff like that. So if you have debt, I would take a more aggressive approach on just personally, I would take a more aggressive approach on trying to get those things paid off because these rates are not going to change dramatically not at all really dramatically, but at least it's the only thing seems to be changing dramatically is if it's to the upside. But their plan to get these rates down is going to take a few years. And depending on how much debt you have, you're going to have to do the math on that to kind of see what pace you're going to be and how much you're going to end up additionally you're going to end up paying. But overall, it's going to be in your best benefit to move quickly to get these rates paid, your debt paid off, because these rates are not going to come down as quickly as a lot of people expected. I was talking about Discord today, and I really feel for the housing market. I believe that we're going to see a wild trip on that. I know that a little over a year ago, when rates were rising rapidly and a lot of people were doing the variable interest rates and the buy down rates, 2-for-1 points and stuff like that, and you can buy a rate down to 3-4%. And the theory was that the rates you're going to be able to refinance by mid-year, end of the year, right? 6 months, right? This is supposed to be this year. You buy toward the end of last year. They was like, hey, rates are going to be down. You can just sign right here, buy down your rate for a year or so. The first year, buy your rate down 2-for-1. We'll give you 4%. You're never going to pay that 7%, 8%, whatever. Rates are going to come down. You'll be able to refinance in 6 months. Just make your first 6 months of payments on time, and you're never going to have to worry about that higher payment. Well, that's not appearing to be the case. So there is a lot of homeowners that signed up that kind of got in on the back end of the rates as they were rising and were able to get homes, that they're going to have to make those adjustments to make those higher payments, because even the people that signed in, that joined like at the end of last year, that bought the 2-for-1 buy down or had the year buy down rates and stuff like that, even if their rate goes to 7% or something like it's still lower than what the rates are now. So they're going to have to stomach those payments for a while until rates get favorable. So it's going to be a little, like I said, it's going to be a squeeze. I know a lot of the homeowners do have some of those historic rates, so they're not going to be re-entering the market. So you'll probably, between the homeowners who have the historic rates and the people who can't afford the homes and the people who are going to be struggling to make their payments, you're probably going to see a sharp curve in the new homes being built. And this is when you'll start seeing a change overall in the pricing of homes. So this is going to play out, and I think this is going to be a very strong indicator of the monetary policies and stuff like that going forward. Is when we start to see that curve overall in prices, because right now nothing's going down as expected, quote unquote. The housing prices, the interest rates, everything is kind of taking its sweet time and appears to even be like stabilizing, where okay, well, the market isn't as hot as it was a year ago, 2 years ago, but the prices aren't falling. So this is putting a lot of the projections and the people who were waiting to get in and the people who were hoping that the rates come down, it's putting them in an unexpected position. So this is going to be really one of the make or breaks over the next year or two. Whoever the president is going forward, I don't think that we're going to be able to deny the recession. I don't think that we're going to be, because you know how tied our overall well-being and our one of the huge measuring sticks for how well the economy is doing is the ability of people to take on debt. And if we have this slow approach here going on, and this squeeze that's going to be on the people who literally got into the market over like the last year or so, we're going to see some adjustments here, because I know technically it's different from 2008 and they qualified you based off of the higher rate. So if you got to buy down at 4% and your interest rate is going to 7%, I know they qualified you for the mortgage based on the 7%, but that does not negate the fact that people were not planning on paying that 7% ever. And not to mention that inflation across the board is taking its sweet time. So that is going to be, you're going to have a higher mortgage payment than you expected. And then you're also going to have higher cost across the board than you expected. So that's just something to kind of keep in mind, because I do believe that we're going to see whoever the next president is on their term. I know right now they've kind of, the Federal Reserve and Biden and stuff like that, they've kind of denied the recession and the slowdown and stuff that we're in. But I do think that sometime prior to us hit this 2% goal, we're going to be in a position where it's going to be undeniable that we're in a recession. All right. Let me know your thoughts. That's my thoughts on the FMNC and the interest rates and the points and what I think is to come. Let me know your thoughts in the comment section. I appreciate all of you, and I will see you guys in the next video.